Welcome to the DX Today podcast, your daily deep dive into the AI ecosystem. I'm Chris, and joining me as always is Laura. Today we are talking about the biggest capital markets story in the history of artificial intelligence.
Chris, this is genuinely the moment a lot of us have been waiting for, because today, Friday, May 22nd of 2026, OpenAI is expected to confidentially file an initial public offering prospectus with the Securities and Exchange Commission.
Let's set the stage for folks who might be tuning in from outside the finance world, because a confidential filing is a very specific instrument that the SEC uses for emerging growth companies preparing for the public markets.
Right, and the way to think about it is this. A confidential filing lets the company and its bankers iterate privately with SEC staff on the draft prospectus before any of the financials become visible to the broader investing public.
That privacy window matters enormously for a company like OpenAI because it means the first time the world sees actual audited revenue, gross margin, and customer concentration data. The company will already have negotiated language with regulators behind the scenes.
It also means that any material risk factors, including legal liabilities, model safety incidents, copyright lawsuits, and customer concentration with Microsoft, all get hashed out in private comment letters before a single public market investor ever sees them.
Reporting from CNBC, Bloomberg, and the Wall Street Journal earlier this week converged on the same timeline, which is that Goldman Sachs and Morgan Stanley are leading the deal, with JPMorgan Chase also playing a meaningful underwriting role.
And the target window for the actual public listing is roughly the fourth quarter of 2026, with some sources suggesting September as an aggressive scenario if the SEC's review moves quickly and market conditions cooperate.
Let's talk valuation, because the numbers here are honestly hard to wrap your head around, even if you have spent the last few years watching private AI rounds get progressively more enormous in size.
OpenAI's most recent private round, which closed in March, valued the company at roughly $852 billion post-money on a $122 billion primary and secondary capital raise.
That was already, by a wide margin, the largest private fundraising event in the history of capitalism. And yet the IPO target is reportedly above $1 trillion on a fully diluted basis.
To put $1 trillion in context, that would make OpenAI larger at debut than every company in the S&P 500, except for a small handful of mega-cap technology platforms that took decades to reach that mark.
And the question that every institutional allocator is asking right now is whether the public markets can actually digest a float of that size without serious indigestion in the rest of the AI complex.
Exactly, because even if OpenAI only sells, let's say 5 to 10% of the company in the offering, that is still $50 to $100 billion of fresh equity supply hitting the tape in a single window.
For comparison, SpaceX is also preparing its own filing. Saudi Aramco's 2019 IPO raised roughly $29 billion, and Alibaba's 2014 debut raised about $25 billion. So this would dwarf both of those landmark transactions.
And the timing is fascinating because SpaceX filed its own prospectus essentially in the same window, which means the public markets in late 2026 are going to absorb two of the most consequential private technology offerings of the modern era essentially back to back.
That overlap is going to test investor appetite in a very specific way, because both companies are capital intensive, both are heavily personality driven, and both have governance structures that depart significantly from traditional public company norms in important ways.
Now let's look under the hood, because valuation only makes sense in the context of the underlying business. And OpenAI's underlying business has genuinely changed shape in a very short period of time.
As of February, the company had reached roughly $25 billion in annualized revenue, which is up from $20 billion at the end of 2025 and up from about $13 billion at the start of last year.
That growth curve is roughly doubling year over year, driven by ChatGPT consumer subscriptions. The enterprise tier, the new self-serve advertising platform launched earlier this month, and increasingly meaningful contributions from the Agent and Codex product lines.
The advertising platform alone is a fascinating subplot, because OpenAI is now publicly targeting $2.5 billion in ad revenue this calendar year and $100 billion in annual ad revenue by 2030.
But here is the part that any prospective public market shareholder has to stare at very hard before clicking buy. And that is the cash burn profile, which is, to put it gently, breathtaking.
Internal projections that have circulated suggest cash burn of approximately $27 billion in 2026 and roughly $63 billion in 2027, with the company not projecting positive cash flow until 2030.
That means the IPO is not really a victory lap for a profitable franchise. It is, in many ways, the funding mechanism for the next phase of compute, data center, and frontier model investment.
Which actually makes the public markets a logical next step, because the private rounds have effectively maxed out the pool of investors willing to write multi-billion-dollar checks at this kind of valuation.
And it dovetails with the October 2025 recapitalization, when OpenAI converted from its old nonprofit-controlled capped profit structure into OpenAI Group PBC, a Delaware public benefit corporation, with the OpenAI Foundation as a controlling shareholder.
That recap is the legal precondition for any IPO, because you cannot list a capped profit hybrid on the New York Stock Exchange. You need a clean equity instrument that public market investors actually know how to price.
The foundation retains a meaningful equity stake and, importantly, governance control, which means the post-IPO structure will look closer to a dual-class arrangement like Meta or Alphabet than a one-share, one-vote pure-play company.
That is going to be one of the more controversial elements in the actual S1 when it eventually becomes public, because dual-class structures and trillion-dollar valuations together tend to draw a lot of governance scrutiny.
Let's also talk about Microsoft, because Microsoft is the other player that has to be reflected on essentially every page of this prospectus, given how deeply intertwined the two companies have become over the past several years.
Microsoft has committed $13 billion in total funding to OpenAI, and as of March 31st of this year, approximately $11.8 billion of that commitment had been funded.
On an as-converted basis, Microsoft now owns roughly 27% of OpenAI, which is a stake that, at a $1 trillion valuation, would be worth approximately $270 billion to Microsoft shareholders.
And in April, the two companies restructured the revenue share arrangement, capping the payments that flow back to Microsoft, which I think most analysts read as both companies preparing the cap table for the public market debut.
That restructuring is going to look very different on the income statement, because the revenue share to Microsoft has historically been one of the largest single-line items in OpenAI's cost of revenue.
There are also serious questions about the inference cost structure that will get disclosed for the first time, because most of what we have known about OpenAI's gross margins has been leaks rather than audited filings.
Right, and once those numbers are in the S1, the entire industry, including Anthropic, Mistral, Xi, and the Chinese labs, will be able to benchmark their own cost structures against the genuine reference dataset.
Speaking of Anthropic, they had their own headline week, because Anthropic shared projections showing about $10.9 billion in revenue for the quarter ending in June, up roughly 130% from Q1.
And Anthropic projects its first ever quarterly operating profit of approximately $559 million in that same window, which is a very different financial posture from the company filing for the IPO today.
That contrast is going to come up in every analyst meeting, because investors are going to ask why they should pay $1 trillion for a company that is burning $63 billion annually 2 years out.
The answer, of course, is the option value of frontier AI scaling, the consumer brand, the global ChatGPT install base, and the bet that OpenAI's models will continue to define the leading edge of capability for years to come.
And the bear case is essentially the inverse, which is that compute costs do not come down fast enough. The moat around foundation models compresses, and the cash burnout runs even the most aggressive revenue ramp scenarios.
It is worth noting that Chinese models have gone from 1% of usage on the developer platform OpenRouter at the start of 2024 to more than 60% by this month, which is a real competitive signal.
That data point is one of the most important things any public investor should pay attention to, because it suggests the global frontier is fragmenting along geopolitical lines in ways that affect every American AI provider's addressable market.
Now let's talk about market mechanics, because a $1 trillion IPO with the kind of public retail interest OpenAI commands is going to create some genuinely strange dynamics in the underwriting and book building process itself.
Goldman and Morgan Stanley will run a very wide marketing roadshow, probably global, and there will likely be a meaningful retail allocation through directed share programs and brokerage platforms, because the brand strength here is enormous.
And there is real concern, particularly in the crypto and equities communities, about a liquidity crunch, because investors may rotate out of other speculative or AI-adjacent positions to free up capital for the OpenAI debut.
We saw a smaller version of that dynamic around the ARM Holdings IPO in 2023 and around CoreWeave more recently, but at $1 trillion scale. the gravitational pull on the rest of the market could be quite significant.
For sovereign wealth funds and the largest pension allocators, this will likely become a multi-year position rather than a flip, because OpenAI is one of the very few assets that can absorb their kind of check size.
And for regulators, this is the moment when the most consequential AI lab in the world becomes subject to quarterly earnings cycles, Sarbanes-Oxley controls, and shareholder lawsuit dynamics that have shaped every prior platform giant.
That last point is genuinely important because public company governance creates a very different incentive structure for capital allocation, model release cadence, and safety investments than the private, nonprofit controlled structure we have lived with for years.
Some safety researchers I respect worry that quarterly earnings pressure will accelerate product releases that should have stayed in evaluation longer, while others argue that disclosure obligations actually improve transparency for the public good.
It is also worth saying that the OpenAI Foundation, as the controlling shareholder, has explicit mission obligations that flow into the PBC charter. So this is not a clean conversion to a normal for-profit listed entity.
That charter language is going to be one of the most carefully read documents on Wall Street once the public S-1 finally drops, because it defines the precise scope of the foundation's veto and governance rights.
For listeners thinking about how to track this story, the confidential filing itself will not become visible. The public S-1 comes next, probably in late summer, and then the actual roadshow and pricing happen in the fall.
In the meantime, every public AI proxy stock from NVIDIA to Microsoft to AMD to Oracle is going to trade partly on the read-through implications from OpenAI's eventual disclosures about training compute and inference economics.
My honest take is that this is the moment the AI industry stops being a venture capital story and becomes a public market story, with all of the discipline and dysfunction that transition implies for everyone involved in the field.
I agree, and I think the most consequential thing about today's filing is not the valuation headline, but the signal that frontier AI development is now permanently inside the orbit of quarterly capital markets accountability.
We will be watching every leak, every amendment, and every analyst note as this process unfolds, and we will be back with deeper dives on the structural and competitive implications as they become clearer.
For our regular listeners building product, evaluating vendors, or just trying to understand where the AI ecosystem is heading, the actionable takeaway is that the cost and capability curve for foundation models is now a public audited number.
That visibility changes how every enterprise procurement team negotiates contracts, how every competing lab benchmarks itself, and how every regulator weighs the systemic importance of a single laboratory inside the broader information economy of the United States.
That's all for today's episode of the DX Today podcast. Thanks for listening, and we'll see you next time.